Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Domino's Pizza Incorporated, ticker DPZ. Over the next few minutes, I'll discuss my thoughts about the business quality of this company and its valuation. I'm excited to dive into this one, and I feel like I should be doing this over a piece of pizza, but I am not. First up is market cap of $12 billion, enterprise value of $17 billion. So you see about $5 billion in net debt. Pretty significant amount of leverage on a business like this, of this size. So we'll see how that plays out. Operates in the hotel, restaurants, and leisure industry. For those who do not know, Domino's Pizza operates a pizza company in the U.S., has three segments: U.S. stores, international, and supply chain. It offers pizza under the Domino's brand name, company-owned and franchise stores. Oven makes sandwiches, pasta, boneless chicken. They have 18,000 stores in 90 markets. Very large business. Has a beta of 0.687, which is quite low, lower than 1. The lower it is tends to mean a lower volatility stock, and tends to be one of the signs I look for a potential high-quality business. So I like what I see there. Now, the return on invested capital chart is very, very interesting to me. Now, one of the things I want to see when I look at this chart is I want to see 20 straight years of profitability, and barring that, maybe just 1 year of loss. But we do see 2 years of losses here in 2003 and 2004. So that is a negative on the sign of the business quality. However, since 2004, you have 17 straight years of profitability. And the return on capital in every year since then has been amazing. So I like to see return on capital of at least 10%. The lowest year after 2004 was 16% in 2007, 17% in 2008. But you've spent a lot of time above 50%, which is just outstanding. I mean, you have improved steadily since 2007, 16%, 17%, 27, 35, 43, 48, 60, 61, 53, 57. These are just amazing numbers. And over the last 3 years, we've been at 57%, 51, and 49%. Our 10-year median returns is 57% return on invested capital. These are outstanding numbers. When you see numbers like this, you should get really excited as an investor, because basically any money that can be reinvested in the business should be reinvested in the business, because that's going to drive amazing returns for you as a shareholder. Now, what I like to see from return on equity is 15% or higher. It basically becomes irrelevant when you see a return on invested capital of number of 57%, because it means the return on equity is going to be higher than that. But what do we see here? We have a surprise. We have negative return on equity, and that's a negative 12%. That suggests we're losing money. But this right here tells us we're not losing money. So the only way to get a negative return on equity if you're profitable is to actually have a negative book value. And your clue is that you have a negative price to book here. That means we have negative book value. This is one of the best signs of a high quality business that will surprise people. A negative book value only originates from buying back shares above book value over time and having bought back so many shares that you've actually turned the shareholders' equity line negative. Now, we'll see that when we get to the balance sheet. I'll break that down a little bit more. But these are all signs of a very high quality company. Domino's clearly is operating at a very high level here. I also want to note, you don't need a high gross profit number to pull off this high return on invested capital. Your return on invested capital here is much higher than your gross profit. You can do that from a high turnover. Pizza is certainly a high turnover business. Just goes to show you don't need high gross profits in order to make that profitability number on a capital basis. Now, PE is high, 26. I like to buy companies with PEs of 15 or lower. However, it's hard to say this company is overvalued because they are growing at double-digit rates. You have a 10% revenue growth, 13% asset growth, but 15% free cash flow growth, which basically means you're going to double your free cash flow every 5 years. 23% EPS growth, which is basically you're going to double your EPS every 3 years. These are outstanding numbers. So it doesn't show overvalued necessarily. It can justify a price like this when you have amazing growth like this. Now, one of the things that's happening here is a lot of operating leverage. You're growing your earnings and your free cash flow much faster than revenue because your gross margins are growing, which is allowing you to grow your operating margins, and basically everything's expanding from there. I mean, look, you have gross margins have gone from 30% to 38% over the last decade. That's very, very good. Operating profit margins have gone from 16.8% to 17.9%. So you've gained 1% on the operating line, but not as much as you have on gross margin line. So there is some loss of operating leverage there. EPS, though, is doing really, really well. Look at this, $1.91 to $13.54. That's a 5-6x over the course of a decade. Very, very strong numbers. 7x, actually. It's almost a 7x over the course of a decade. If you can 7x your earnings over a decade, shareholders are going to do extremely well. Look at these earnings growth numbers. 11%, 29, 15, 21, 23, 35, 43. This is not a fluke, this number. They're growing at very strong rates over time. They're also doing that growth while continuing to pay a dividend that's growing at 20% a year. Very, very attractive numbers. So everything here is impressive. I'm really loving what I'm seeing from Domino's. We're going to dive in more to the income statement and balance sheet next. But before we do, hit that like button. Don't forget to subscribe. I'm working through every company in the S&P 500. I'm building a watch list of all the best companies. You need to check it out. At the end of this video, you'll have a playlist where I've done all the past videos so far, working A to Z. I hope you'll join me. Let's go to the income statement. Now they are selling pizza, so you're going to see cost of goods sold, rising over time. Their SG&A has gone up 4x, so it's growing actually faster than their gross profit. That's not the best sign that your SG&A is growing faster than gross profit. It's why your gross profit operating leverage has been better than your operating profit leverage, but it's not terrible. Net income. This is what's really interesting. Your net income has gone from 112 million to 510 million. You've 5x'd your net income, but you've 7x'd your EPS. Now, why has that happened? It's because of these share buybacks. Really impressive share buybacks. You've had 59 million shares outstanding. You've reduced it to 38 million shares outstanding in a decade. So you've bought back over a third of your shares outstanding in 1 decade, which is going to add an extra 3% per year to your return as a shareholder. Very, very good numbers. And you've really seen that accelerate over the last 5 years, really focusing on that. So that's been a really good use of shareholder capital. That's why you see this massive growth in EPS faster than net income. This is what you want to see with an investment. You want your shares to decline. You want your EPS to grow faster than net income. You want net income to grow faster than revenue. All of this drives really, really strong shareholder returns in the future. Now, balance sheet. This is what I want to show you. Negative shareholders' equity. How does this happen? This happens because your assets are smaller than your liabilities, which on a lot of companies would basically be a sign of imminent failure, but it's not, because your current assets exceed your current liabilities, okay? So like you have current assets here, 861 million. They exceed your current liabilities of 591 million. So the business is solvent, okay? It's solvent every year. You have that set up. The difference is this company requires so little PP&E, 500 million of PP&E, but they have 5 million in debt, 5 billion in debt. So 10 times more debt than PP&E. Normally this would be a negative sign. Why is it not? It's because cash flow is really, really good. Earnings are really, really good. Your debt is 5 billion, right? Let's go back to the income statement. Income statement is 500 million. So this is 10x leverage on your net income. It's a very leveraged business. No mistaking the leverage of the business. But why can they pull that off? It's because what they've done is they've actually been buying back shares and they've turned their shareholders' equity negative. If you buy back shares above book value, it lowers your retained earnings. You see your retained earnings dropping each and every year. They make money, that drops their retained earnings more because they're dumping that cash into share buybacks. It turns the shareholders' equity negative. And so this business is being run on a very low amount of liability and equity. Total assets, 1.5 billion, right? And then the income statement is on that 1.5 billion in assets, you're earning 500 million in net income. 30% return on assets, very, very attractive. That return on assets here, 30%, driving everything. Now the cash flow is going to show the lesson here. Net issuance of common stock, massive buybacks, massive buybacks. These buybacks are occurring at prices that are attractive for shareholders because they retire shares, they raise the net income, but from a balance sheet perspective, they were having to be bought back at above book value. What do I mean by above book value? Let's go back and look at this liability and equity number. Okay, let's call it $1 billion here. Your book value is negative now. It hasn't always been negative, but it's negative now. Your assets, 1.6 billion. We need to compare that to your market cap. Your market cap is your enterprise value is basically 10 times the size of your assets. Why is that? That's functionally like having like a price to book of 10. If you just think about book as only assets and you ignore the liabilities, that's not truly how it works. But it's saying that your liabilities, like your equity is being operated negative, right? There's no net tangible assets. But the market cap is still valuing the business at $12 billion. And that's just an admission that you don't need equity in this business to run it. This business is being funded completely by debt. Completely. And so this is kind of like a private equity type strategy in the public markets. It's been very effective, and it's allowing shareholders to have a very attractive rates of return. And you're going to continue to see that over time because as the company pays dividends, as the company issues stock that exceeds see what's happening is they're exceeding their net income. They're paying more in stock buybacks and dividends than their net income. Now you can't do that forever, but it's basically like a leveraged buyout of the company. They're taking on debt to make that payments. Normally that's a bad thing, but if you manage it well, it can be very, very attractive for your shareholder returns. Now, it does mean in the future your growth is going to be probably a little bit slower than this. I wouldn't pencil in 23% growth, but with the way they're growing revenue, 10%, the way they're buying back shares, you might be able to pencil in 12 to 15% rates of future EPS growth for a company like this, and that could be very attractive as a shareholder. And especially as long as the capital allocation is good, as long as you have high returns on invested capital, you're going to end up with a very good result. So for me, Domino's Pizza, easy add to my watch list. Definitely a company that sounds very attractive. I'm a customer, and I think being an investor someday would be very interesting. So thank you for listening. Don't forget to like and subscribe to the channel. That'll let YouTube know that you're enjoying my content. That's the only way I can grow, so I need your support there. If you'd like to support me more directly, you can do so by using my affiliate link and joining quickfs.net. As a free or a paid subscriber, if you click on the link in the description, the first link in the description is a link to quickfs.net, where this is the software I use to analyze companies. I find it very useful. I think it would be helpful to you as an investor to learn how to value companies as well. So if you'd like to check it out, it has both free and paid accounts. Use my affiliate link. I get a commission when you do. So that's a great way to support the channel in a more direct manner. Thank you for listening, and until next time, stop paying fees, start building wealth.